Hey everyone, Ed Connerkey back with Connerkey's Money Corner. This week I had a client reach out to me and ask me a question, which is a great question. Ed, can I lower my monthly mortgage payment without refinancing? I have a 4.125% interest rate, and that's too good of an interest rate to give up knowing that rates are much higher today. Is there a way I can lower my monthly payment but not refinance and lose that interest rate? And the answer is yes. And surprisingly, most people don't know this. Most people, even in my mortgage industry, don't know this. That you can do what Fannie Mae and Freddie Mac call a recast of your mortgage, where you can recast your mortgage when you throw large sums of money into it. For example, let's say that you had $25,000 in your savings account and you want to take that money and you want to lump down your mortgage. And if you just did that the normal way by adding it onto your mortgage payment and sending a check into the mortgage company, you wouldn't see any payment relief. You would still have that same principal and interest payment due the following month. But if you reach out to your mortgage servicer and ask them to recast the loan with that large amount that you're going to drop into it, they are required by Fannie Mae and Freddie Mac to reduce your principal and interest recasting that loan. Now, this sounds like a great thing, right? Getting a lower mortgage payment without having to refinance. But let me caution you on something here. And this goes to that old adage, just because you can do something doesn't mean you should do something. Now, our brains as human beings are wired and we think monthly payment. I don't know what it is, but that is our brains thinking monthly budgeting, monthly payment. Payment is everything. I've got to get my monthly mortgage payment down. And unfortunately, that makes us do some crazy things like this. Giving away $25,000 to pay down a 4.125% interest rate, which I explained to the client is really 2.8% net effective rate after his mortgage interest tax deduction, because that's tax deductible debt, is not a bad thing, but it's not the best thing. Meaning taking that money to knock down the mortgage payment and only yield a 2.8% savings is not as good as keeping that money somewhere else where, one, it can make more than that 2.8%, and more importantly, it can be liquid and available if things were to happen. A loss of job, a medical crisis, the roof leaks, the car breaks down, an appliance goes out on you, and you need cash. Once you've put it into the house by paying down your mortgage, you'll never see that money again until you're able to sell your home. So it's really important to understand that monthly payment is important, but we also have to focus on your holistic financial plan and make sure you've got enough money invested elsewhere or liquid in your rainy day fund, or better yet, maybe that money would be better suited to pay off other non-friendly debt, non-tax deductible debt. So, two things to walk away with. Yes, you can recast your mortgage. Have questions on that? Contact me, let me know. But be ready for me to objectively persuade you to put that money somewhere else where it may be doing better good for you than it is sitting in your house. I hope you enjoyed this Connerkey's Money Corner. Talk to you next time on Connerkey's Money Corner. And yes, any questions on any of this, always reach out to me. I'm happy to help. Talk to you next time on Connerkey's Money Corner.